there's just been very little new construction in the grocery-anchored shopping center business. And at the same time, retailers are expanding. And as they expand, our space becomes where they want to be, which gives us more pricing power than we've had historically. And we think we can, a lot of these properties that we buy, there are old rents in there that we can actually get in and get better rents and really grow the overall cash flow of each property.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today we're taking a close-up look at how a non-traded REIT and a public REIT have come together to form a joint venture focused on acquiring open-air grocery-anchored shopping centres. On the episode today, I'll be speaking with James Corl, head of the private real estate group at Cohen Steers, as well as Jeff Edison, chairman and CEO of Phillips Edison & Co., a publicly listed REIT. So welcome to you both.
Nice to be here.
Thanks, Sarah, for having us on.
So James, let me start with you. Can you describe the origins and strategy of the Cohen Steers private real estate platform and how you view conditions and opportunities in the commercial real estate market today?
Sure. This is a very important new effort for Cohen Steers. We have a long history in the private wealth space, and as private wealth clients begin to request more alternative type investments, this was really a way for us to accommodate that desire. So it's an important effort for us. And so our strategy is really to utilize our real estate expertise, what we call high conviction sector selection, and taking advantage of the fact that private follows what the listed markets do and gives us particular insights into private markets, and take that expertise and harness it in the private markets on behalf of our clients.
Great. And Jeff, how did the partnership come about and what makes it attractive for PECO's broader strategy?
We have been in the business for 30 years, as Cohen Steers has been. Cohen Steers has been for an awful long time. And we've bumped into each other over a long period of time and worked back and forth on different deals we've talked about and stuff. And so we've known each other for a long time. And when we were looking for a partner to help grow our ability to buy in the grocery-anchored shopping center business, we were looking for somebody who looked at the grocery-anchored shopping center business similar to what we do. And that is that when you're in the grocery-anchored shopping center business, each center is its own company, and each one has to win in its very specific market. And that's something that Cohen Steers understood and was an important part of our partnership to make sure that we were both thinking similarly in terms of what we were looking to buy. We spent a lot of time. We've actually been working on this for quite some time to make sure we got that understanding, but also had it set up the right way. And I think Cohen Steers also saw the strength of the grocery-anchored shopping center business, and how when you take a nationwide look at it, you can find really strong opportunities for investment, which is what we've been doing for 30 years.
James, for you, why was PECO such a good fit?
So there are a number of reasons. When we take objectively, the company clearly has a great operating expertise. They have a national platform, which means they're in many different markets, big markets, small markets, coastal markets, interior markets. That was important to us. They, of course, have the great tenant relationships with all the major players in retailing that you really need to have to be able to access that privileged market information that enables you to understand how the tenants are doing in the space and what the value of those boxes that they occupy are to them. We also have a long-term relationship with the company. We've had the ability we've known them for many years and various individuals in the company for many years, and have had a chance to watch them operate skillfully in the market for many years. And specifically, since they've become public and their specific operating metrics have been out there publicly, we've been very impressed with how they have really outperformed their peers in terms of the operating metrics on the ground, the leasing metrics, the releasing spreads, the growth they've been able to generate in their assets. And so I think that was pretty clear to us. But on more of a subjective basis, I think we both see beauty in shopping centers in the same way. There's a lot of different metrics, and we'll get into this later probably, but there's a lot of different metrics that you could look at to evaluate a shopping center, I think. And I think their view of what a great center looks like and what it takes for a great center to make a great center perform really well is frankly just very similar to ours we see success the same way, we see value the same way, and so that made them a very natural partner for us, I should say.
And are there any particular challenges when a non-listed REIT teams up with a listed REIT?
I don't think so, because as Jeff said, we talked about this for a long time before we actually put pen to paper and actually crafted the joint venture agreement. And it was very clear as we got into those talks that we really did view value at the same way. But I think more on point to your question, we understood very well that PECO was essentially, we knew the type of assets we wanted to buy, and the type of assets we were targeting were very adjacent to PECO's owned portfolio. And we were looking at things that were similar, but we have a little bit different twist on what we're interested in. So we knew they'd be seeing a lot of those things. But as a big market, there's lots of opportunities. The pricing is really advantageous here. We had enough similarities, but enough differences. Enough similarities in what we were looking for, but slightly different parameters in terms of what we're targeting, so we wouldn't be bumping into each other.
And the first acquisition was made in Missouri this July. How did that come about, and how does that tick the boxes that you're looking for?
It's Phillips Edison's job that they really have the sourcing capability, right? They are in the flow of, as far as I can tell, about every grocery anchored and grocery anchored adjacent or anything that remotely looks like a grocery anchored center in the country. Their people are sifting through them all. They know the types of things that we are attracted to, and they presented us with many. And this is the one that really got a lot of traction with them. They were very impressed by the trade area, which is to say the 3-mile ring around the center. It's a very high income demographic. There are great growth parameters. The suburbs of St. Louis are actually benefiting from what's going on in the downtown. So there's growth there, there's wealth there, there's great vehicular traffic. The center is laid out well. It's anchored by a grocer that's a very strong grocer in the market and really a dominant grocer in the market, and does terrific sales. So there's going to be a lot of traffic, customer traffic, for the other merchants around the grocer to monetize, and for PECO's operating envelope to be able to merchandise around that grocer. So it really had everything. And then, of course, there was the price. Getting it the right price is critical.
I would just add there, we've been one of the largest buyers of grocery-anchored shopping centers, particularly on an individual basis, of anyone in the country. So when anything comes for sale, people come and talk to us about it. And we're working in a market where we define quality somewhat differently than everyone else is. We call it SOAR, which is you got to prove that you can get great spreads, you can have high occupancy, you have advantages of the market that specific center competes in, and then you have strong retention. And we've been market leading in all of those categories, and the center fits directly into that bucket where we can get that kind of quality.
And Jeff, was that a new market for PECO?
We have other projects and have over time in St. Louis. And, Schnucks is the number one grocer in that market. The store is doing very well, one of their better stores. So I think it's a great fit.
That really highlights something that was important to us and is extremely valuable going into a marketplace, is that because I talked at the top about how PECO's in a lot of different markets, geographically distributed across the country. How many states are you guys in, Jeff?
31
states. And so the fact that they have assets on the ground just a few or a handful of miles away from this asset, and with the same grocer, that gives us a level of confidence that they are really the local sharpshooter in all these places, because they're already dealing with tenants. They know the particularities of the quirks of the marketplace, the particularities of what the tenants want and what concepts do well in that part of the country, et cetera. So it's really valuable, like granular information that if you weren't managing assets in the St. Louis suburb, the western suburbs of St. Louis, you wouldn't have that same level of texture. So that it's really valuable in the shopping center space where you live and die, you win or lose based on what happens inside those 3 miles. And if they already know what's going on in that 3-mile ring, then it's a tremendous advantage.
Yeah, I would say, Sarah, one of our mantras inside PECO is we have to be really locally smart, because we compete in a local market, and having other product in that market makes you initially locally smart, but then you got to get boots on the ground at the center to make sure you have the merchandising mix at that center that maximizes the sales, which then allows us to maximize our growth and of rents our ability to keep occupancy at high levels and create a great shopping experience for the customers, not in St. Louis, but in that very specific market of St. Louis.
And as you source future acquisitions, are you going to be looking at any certain geographic markets, or are you fairly open to where the opportunity lies?
I would say generally you want to have the wind at your back. And a lot of markets are a lot of MSA, metropolitan statistical area, MSA level markets are growthier markets by definition. So those would be obvious places where you have wind at your back. And look, in the case of St. Louis is not a growthy market per se, but the sub-market that we're in, the 3 Mile Ring that we're in, the particular western suburbs that we're in, are for kind of microeconomic reasons. There are different reasons why you could have a trade area that gives you the tailwinds that you're looking for. So I would say, yes, you're more likely to find assets that have a growth characteristics in the trade area, in the Sun Belt, in the Mountain West, but that wouldn't rule out being able to find those growth characteristics submarkets in a market where you wouldn't say the whole MSA or the whole state or the whole city is a growth market, but you can find nuggets of growth at the micro levels. Again, that's why their presence in many markets is really important, because there are a lot of different places where you can find a 3 Mile Ring that's got the tailwinds that you're looking for.
And Sarah, 10 years ago, we developed an algorithm that we use to analyze the specifics of that trade area. And that's become a very valuable tool to identify very specific markets where we can be successful. It's been a part of our acquisition discussions with Cohen Steers and but it brings a long-term knowledge of markets to very specific centers and allows us to give even more insight. That algorithm does tend to push you to some of the markets that are growing faster, but it also helps you to identify unique opportunities.
And can we just talk a bit about transaction activity and whether the likelihood of lower interest rates in the months ahead could really alter the landscape that you're working within?
Last year was probably one of the most difficult acquisition years, with interest rates moving the way they were, and volume was down fairly significantly. We are seeing that trend change. We've seen significantly more product this year than we did last year. So the market, there is more for sale. We're having to compete in certain markets more aggressively than we had, because there are more buyers. We've been doing this in the grocery anchor shopping center business for 30 years, but it's been more attractive to more investors. So we're having to work harder finding the pricing and the metrics that work in that market. But I would say we're optimistic. The market continues to be, we're seeing more product on the market, and we anticipate that trend will continue.
Yeah, that's right. Look, the Fed decided they need to raise interest rates. REITs went down immediately in 22, at the top of 22, at the beginning of 22, when REITs declined. Sympathy with that, and the public markets respond first. And at that time, we said private real estate values will follow, and they're headed down as well, because listed leads private, as we say. We really didn't want to do much in 22 and 23. We sat on our hands for most of 23 because our view is private market values were going to come down, and then they would bottom, and then transaction activity would return. And that is, of course, in fact, what has happened. And now that rates are, now the Fed's on the other side of that, as has been the case in many cycles before, you'll see that will put a bottom under asset prices. And so we believe that prices have bottomed in grocery space. And that's why we're being very active. And we're seeing a real crescendo of activity. I think there were some seminal transactions earlier in the year that I think awakened people to the fact that the floodgates of product were going to open. And I think we're back to regular way businesses. I know, Jeff, I'd call it a balanced market right now. We like the pricing, but when things get put out for sale, there's a normalized. They're not the scantest bid sheets you've ever seen, nor the most populated, somewhere in between. So the market's normalized this year.
I think is the key of that is there's just been very little new construction in the grocery anchored shopping center business. And at the same time, retailers are expanding. And as they expand, our space becomes where they want to be, which gives us more pricing power than we've had historically. And we think a lot of these properties that we buy, there are old rents in there that we can actually get in and get better rents and really grow the overall cash flow of each property.
Great. And Jeff, any particular retail trends or themes that are crossing your desk right now that you're paying attention to?
Well, I think the biggest driver has been the growth of primarily urban retailers who are seeing the great advantage of the suburbs. They hadn't built out the same density in suburbs that they had in more urban environments. And Chipotle is a good example of that. Starbucks is a good example of that. These are national companies that are realizing they need to be closer to the consumer and that they are building out that format, which is driving demand for our centers. And with limited new supply, our centers become where they want to be. And that gives us pricing advantage.
Great. James, I'll leave it to you to close with any final thoughts.
I think the most important thing we see that's happening under the surface is that, look, retail went through, we all nicknamed the retail apocalypse for several years. And that was really a function of e-commerce coming along and disintermediating the segments of retailing that I would say were ripe for disintermediation, like the bad merchandisers out there, the bad retailers. We all know who they were. They all went bankrupt. And I think what investors have yet to really latch onto is, and why retail is shopping centers are performing so well, is there is an emerging equilibrium between the store-based retailing model and what I'll call the smartphone / warehouse-based retailing model. That second model, that new model, took market share. And it took market share for several years, and it chewed into market share. But what you're seeing is that curve is now flattening. And the retailers, the store-based retailers, have incorporated that technology into their own models, and they are, and so I think we're reaching a new equilibrium where the stuff that it lends itself towards warehouse-based fulfillment is already being done there, and that there is a return to the centrality of the store in the value chain for getting goods and services to consumers. For a long time, it looked like everything you're going to get all your stuff from a warehouse. And now people are realizing that's not true. And so the value of the store is on the rise because the technology has actually equipped good, what we call omni-channel retailers like a Target or like a Walmart that now came out of nowhere and now has 80 billion of their 600 billion in sales every year. The largest retailer in the world, is 80 billion of their 600 is now originated online. Those are e-commerce sales. But most of that is being fulfilled in the store. So the store is closer to those consumers, and you don't have to have a van. And so the store is becoming centered in that omni-channel world, and that is making the stores more valuable, more scarce, and that's why they're good investments.
And Sarah, I would say from our perspective, we are very excited about this partnership. We're very excited about its potential to be a significant player in the market. We do have a similar view of how the grocery anchored shopping center works, which makes us, I think, really great partners.
I would say I wholeheartedly agree with that, and it's a great partnership, and we're just super excited about working with PECO.
Thanks to both of you. And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.